Welcome back to another episode of Grit, Grace, and Growth. Today, we are tackling a question that I'm getting so frequently as of lately. So, over the past year, even year and a half, this is a question that I'm getting. I bet you every single day that I have a conversation with prospective students, I'm getting this question several times. And that is, shouldn't I wait until interest rates drop or the market flattens out and decreases until I begin investing in real estate? It is so expensive. And interest rates are 6.5, 7, 8% for a mortgage. So shouldn't I wait? Should you? Well, let's dive into this topic and explore more important considerations to help you make a more informed decision. So, first off, let's talk about interest rates historically. Over the last 100 years, an average interest rate for a 30-year fixed mortgage has fluctuated significantly. And that's something I don't think that people really have looked at and realized. So they're looking at, interest rates of 2000 during, when COVID broke out, when people were able to obtain a 2.5, 3.5% interest rates, and even prior to where interest rates were averaging around 3 to 4% for a mortgage. However, if you go back over the last 100 years, there have been several times where interest rates were at 7, 8, 9, 10% for a mortgage. Um, so again, rates have ranged from highs from around 18% even in the early 1980s to again the lows that I mentioned of COVID times of 2.5%. So the long-term average of where we are today at 7, 8% really is nominal. Either way, it's all about perspective. All right. So let's look at things in perspective now. It's interesting to note that while many people hesitate about investing in real estate at a 7% interest rate, they are often also willing to go out and charge unnecessary items like a night out, a meal on a night out, a new pair of jeans that was on sale, whatever it may be. They're more than willing to go out and charge those items on their credit card, which has a whopping 26, 27, even 28%. And on average, statistically, most people do not pay their credit card off in full month after month, carrying balances, hence incurring that high, hefty interest rate. So similarly, taking out a loan for a new car, even at 7, 8, 9% is common practice nowadays. Over the past 2 years, the average interest rate for a new car ranges between 7 and 9%. And how many individuals go out and have purchased a new car in the past year alone, incurring and signing off on an 8% loan for the new car? Yet, when it comes to investing in real estate at similar rates, there is huge hesitation. And why? Why is this? Really? So, real estate versus high interest liabilities. Okay, so we have real estate, which is an appreciating asset, and then you have high interest liabilities like a car. So, I'm not saying all cars are liabilities. There are some that are deemed assets, vintage vehicles, certain types of vehicles that are deemed assets. But the average vehicle car that you go out and purchase, the average car that just about every American family drives, is a liability. And signing it at 8 and 9%, again, is a liability. So it's depreciating in value instead of increasing. So let's take a step back from that as well. Again, real estate is an asset. Unlike credit card debt, unlike car loans, which are liabilities. And so when you invest in real estate, you're really acquiring an asset that's typically going to appreciate in value over time. Almost always, I would say, don't quote me on this, but 99% of the time, it's going to increase in value. It's just about a matter of how long and how much it's going to increase, but it will increase in value. And either way, it will hold value, even if it's not appreciating and increasing in value at a rate that you would expect or desire for it to. It's also building equity, which can generate income for you. So, whether you're purchasing a rental property, a home to flip, or even your own personal residence, real estate often is so advantageous and has so many benefits at even 7, 8% interest rates compared to those high interest liabilities like credit card debt. All right. So now let's dive a little deeper into, I know I've mentioned some of these in the past. You're like, hey, Laura, you've spoken about some of these before, but let's bring them back together in this episode specifically. Some of the benefits about investing in real estate. One, easy go to appreciation. So, no doubt, real estate is generally going to appreciate in value over time. Again, the question is more so is how much and how long it'll take to increase over time. This means if the property you purchased today at $300,000 over a given period of time will go up to 350, 400, it'll increase in value. I can tell you one of the properties that we purchased back in 2001 has already increased over $200,000 in appreciation, also providing equity, but has increased over $200,000 in value in just 3 years, about 3 years or so. Um, Also, let's look at number two, equity building. So, as you pay down your mortgage, you are building equity in your property. This equity you can later use for future investments, for renovations on a property, whether it's your personal property or an investment property, or even use it to pay off or pay down other debts. So you're building property you're building equity when you own real estate. Okay. If I don't know about you, but those are already two selling facts points for myself. Okay. Also, number three, income generation. So if you use your property as a rental, even if it's a flip, but let's just stick to this. If you're using your property as a rental, it can generate passive income, and this income can help you cover mortgage payments. In many cases, even provide additional cash flow month to month. So as long as you run your numbers correctly, you will have cash flow. You'll have some cash flow coming out of that on a monthly basis. So why not even, if you're investing in real estate, you're renting it out, the numbers make sense. You have enough to cover the mortgage, insurance, cleaning services. I know I'm blanking on some of their HOA fees. If you have any of those pesky HOA fees where you're living or investing. And there's another main one that taxes, of course. But you have enough funds to cover all of those required costs and still have additional to put away in cash flow or to save for another day with it for that particular property. Just depends, how much cash flow and what your objective and what you're doing with that. Number four, now this one really does not get enough credit as it deserves, which are the tax benefits of having real estate. So real estate offers various different advantages, such as tax deductions on the mortgage interest, on the property taxes, on depreciation. Oh, and appreciation. This benefit alone can save you significantly in taxable income. Really, tax advantages do not get enough credit as they deserve. All right. And now let's tie into timing of the market again. So, back to the original point of this whole question, shouldn't I wait until interest rates reduce or the cost of real estate is reduced and before I jump in and start investing in real estate or even purchasing my own property? Really? Come on. Trying to time the market perfectly is nearly impossible. Trying to time anything really is near impossible. And I say this to students all the time. I don't care what it is that you're doing. If you're waiting for the perfect time, most likely you are never really going to get started. You're never really going to jump in. You're never going to take that leap because you're always waiting for everything to be perfect and all the ducks to line up. But look at it this way. Being able to jump in and get started, you can always jump in, get started, make adjustments, learn from your lessons. And make tweaks along the way versus sitting on the sidelines and never actually ever having gotten started because you're waiting to have all the knowledge, all the information, you're waiting for everything to line up, all the stars to align before you ever actually make a move. And this is not just related to real estate. This is in anything you do in life. No, I am not saying to jump into things carelessly. Yes, make make a clear judgment there when you're jumping into something new or starting something new. But for the most part, do not sit on the sidelines forever. Who knows how long it'll take you to get started in something if that's the case, if you ever actually do. Okay, so trying to time the markets perfectly is nearly impossible. And interest rates and market conditions are influenced by so many different factors that are beyond your control ultimately. So instead of waiting for the market to be at what you deem perfect, it's often more beneficial to again jump in, find those good deals, finding a market strategy that works for you, and making your decisions based on those factors. Jumping in, learning, making tweaks along the way. And let me tell you this other thing, or share this other thing with you. If you are jumping in and you're getting the knowledge, the experience, the know-how when the market is at 7-8% interest rates for mortgage, what do you think it'll be like when interest rates drop? You will have all the competitive advantage to go in and really act on those opportunities at that point in time because you are experienced, you know how, you have more connections, you're better networked within a network. So it's all much more advantageous to you when the market actually does flatten out or decrease later on. Also, if you're financially prepared and find a property that meets your investment criteria, really, it may be wise to just make that move forward. Again, even if interest rates are higher than you would like. Remember, you can always refinance a mortgage later on. You might flip it later on down the road. If you're making passive income and the numbers align even at that higher interest rate, it doesn't matter. It still makes sense. Really, the key is to make an informed decision and not let fear of the market fluctuate if the market fluctuations hold you back on whether you actually get started and holding you back from potentially lucrative opportunities. So that's it for today's episode of Grit, Grace, and Growth. Thanks for tuning in. And if you found this helpful, be sure to like, subscribe, share, leave a review, and join me next time as we explore more strategies, more questions, and dive deeper into the world of real estate. Remember, with grit, with grace, you can achieve incredible growth. Until next time, keep striving for your dreams.